We'll give you the data through the week with leadership from Michael McKee. Right now, leadership from James Bianco. Jim Bianco's founder and president of Bianco Research. Jim, I'm thrilled to have you on here on a hallmark day of 3-month LIBOR at 5%. What does that signal to you?
That short rates are going to keep going higher, that the Fed at a minimum is going to be higher for longer. And the aggressive call right now is that they're going to move maybe 75 or another 100 basis points, and we could be talking about a 6 handle before the end of the year on the funds rate. But short rates are going to keep going up. And that, I think, is the big driver of why the yield curve has become a new record inversion, because it's all been driven by the long end. When the 10-year rallies, we get record inversions. When the 10-year rises in yields, we get some flattening of the yield curve, or maybe less inversion of the yield curve. And I think that story is going to continue with the bond market.
Jim, do you expect Chairman Powell will be reluctant to lean into that argument, given we're still waiting for payrolls Friday and CPI next week?
No, I don't think he will. I think that, the data, you're right. I heard you before saying, it's just 1 month of data and it's all been very, very strong. But the arc of data that we've seen over the last several months has not been weak. It has not been what Elizabeth Warren, a senator from Massachusetts, has been calling, millions of people losing their jobs. It hasn't happened. Maybe it does, but it hasn't happened yet. And a lot of people thought it would have happened by now. So I think he's probably going to stay with the more aggressive move that the Fed is going to continue to go at least 2 or 3 more rate hikes. And if you're right, if the payroll data is strong, or if the CPI data is strong, that we'll be talking about 50 for the March meeting. Right now, the market's putting about a 30% chance that the Fed will go 50 basis points at the March meeting. It wouldn't take much to push that over 50% and get people talking about it with a strong payroll number or CPI next week.
And the potential for short-term rates to go even higher is the reason why we've been talking all morning about this inversion, this yield curve inversion, the 210 spread, the most inverted going back to 1981. Some people are dismissing this and saying, you can't read too much into it. Other people are saying historically it has been one of the best indicators of recession to come. What is the correct read on this, Jim?
That a yield curve inversion is a forward indicator of recession. More inversion does not mean a faster or harder recession than less inversion. It's a binary thing. Once you go inverted, you should be looking for a recession. Now, the thing about the yield curve is it can lead as much as 18 months before you eventually have that recession. That would put you in the first or second quarter of next year. And I think that the whole narrative around the recession, that a lot of people don't have that kind of patience. They think that the slowdown is going to happen in the next couple of months as opposed to an early 24 story. So yes, the yield curve is a very powerful signal that we might be seeing a very big slowdown in the economy. But just because it's inverting more does not mean it's going to be worse, and it could still be up to a year away.
Do you think that based on that, and based on the readjustment that we've seen in markets for the past, 4 months, do you think that there is a position that seems obviously crowded amid all of this uncertainty?
Oh, that's a good one right now. I think that if there isn't a position that is very crowded in the bond market, it's definitely, higher short rates, that you've seen a lot of speculative positions and a lot of people lining up to basically make a bet that short-term interest rates, the 2-year note, the LIBOR, the Fed funds rate or whatever is going to continue to go higher. Now, the thing about those kind of overcrowded trades is those are less market-driven and more Federal Reserve policy-driven type of trades, so they can be right at times. Other than that, if you want to look for crowded trades, I'd have to, meander outside of interest rates and maybe say the reopening in China is probably on my radar as being the biggest crowded trade that we're seeing right now. Everybody's in on that trade, and with the idea that they're only pushing 5% growth for this year was a bit of a disappointment for that trade.
Jim, are you suggesting we may have seen the reopening trade play out already?
Yeah, I think so. I mean, reopening, yes, the economy is going to reopen. It's going to be stronger than it was. But this whole idea that it's going to be rip-roaring in China, that they are going to produce a ton of stuff, put it on cargo ships, send it to the U.S., and collapse goods inflation in the U.S., I think that trade is a little bit overdone right now, and there's really no evidence that any of that is going to come to pass.
Jim, wonderful to catch up with you, to get your thoughts. As always, looking forward to hearing more from you through the week as we anticipate payrolls on Friday, Chairman Powell tomorrow in front of the Senate, in front of the House on Wednesday. We often tee these things out to be big deals.